The United States government effectively subsidizes religious organizations by an estimated $71 billion annually through tax exemptions. This figure includes federal, state, and local revenue losses across property, income, and sales taxes. Property tax exemptions constitute the largest portion of this hidden subsidy, shifting the burden onto secular taxpayers and businesses. This financial privilege is granted under Internal Revenue Code Section 501(c)(3, classifying churches as nonprofit organizations. Unlike other nonprofits, churches are exempt from filing the annual Form 990, which requires detailed financial disclosure, creating a significant transparency gap. This lack of oversight means the public cannot accurately track how these billions are utilized, raising serious accountability questions regarding public funds indirectly foregone. The legal foundation for church tax exemption rests primarily on the Establishment Clause of the First Amendment, interpreted to prevent excessive government entanglement with religion. The Supreme Court case Walls v. Tax Commission of the City of New York upheld property tax exemptions for religious institutions, arguing that taxing them would create entanglement. However, 501(c)(3) status requires organizations to operate exclusively for religious, charitable, or educational purposes. Crucially, churches automatically qualify for this status without needing to apply formally, unlike secular charities. This automatic designation further reduces governmental oversight and scrutiny of their operational finances and activities, distinguishing them favorably from secular nonprofits. Property tax exemptions are the most financially impactful benefit, directly reducing the tax base of local municipalities. When a church owns valuable real estate, that property generates zero revenue for essential local services like schools, police, and infrastructure maintenance. This lost revenue must be compensated for by increasing property tax rates on secular homeowners and businesses within the jurisdiction. In major cities where church holdings occupy prime real estate, the opportunity cost is substantial, sometimes reaching hundreds of millions of dollars locally. This system forces non-believers and secular entities to financially support the physical infrastructure of religious organizations through higher taxes. Churches are exempt from paying federal and state income tax on donations and most forms of passive income, provided the income is related to their religious mission. Furthermore, most states grant churches exemptions from sales tax on purchases made for organizational use, reducing the cost of operations significantly. Ministers and clergy often receive housing allowances, known as the parsonage exclusion, which allows them to exclude the fair rental value of their homes or cash allowances used for housing from their taxable income. This specific tax benefit, codified in Section 107 of the Internal Revenue Code, is unique to religious professionals and represents a substantial, non-transparent subsidy to clergy compensation. Tax-exempt status is traditionally justified by the concept of a public benefit, where the organization relieves the government of a burden, such as providing charity or education. However, many churches provide minimal or no verifiable community services, focusing solely on worship and internal religious instruction. Unlike secular charities, which must demonstrate quantifiable public benefit to maintain their status, churches face no such rigorous requirement. This disparity means that purely devotional organizations receive the same financial benefits as hospitals or food banks without the corresponding obligation to serve the broader, non-religious public. The lack of a mandatory public benefit test undermines the core justification for the subsidy.
The Johnson Amendment strictly prohibits 501(c)(3) organizations, including churches, from endorsing or opposing political candidates. Violations can result in the revocation of tax-exempt status, yet enforcement by the Internal Revenue Service is historically rare and inconsistent. Many churches engage in thinly veiled political advocacy, distributing voter guides or hosting candidate forums that clearly favor one party or ideology. This political engagement, while retaining tax-exempt status, allows religious organizations to influence elections using funds that are effectively subsidized by the taxpayer, blurring the line between religious practice and partisan politics. A primary argument for removing the exemption is the principle of tax neutrality, asserting that all entities generating wealth or owning property should contribute equally to the public treasury. Removing the exemption would eliminate the indirect financial support of religion by the state, strengthening the separation of church and state. Reform proposals often suggest replacing the blanket exemption with a system requiring churches to file Form 990, detailing income and expenditures, similar to secular nonprofits. Another approach involves taxing only the portion of church property not actively used for charitable or educational outreach, focusing the subsidy only on verifiable public goods. Estimates suggest that taxing church property alone could generate between $25 and $35 billion annually for state and local governments. Implementing federal income tax on church revenue, excluding direct donations used for charitable purposes, could yield additional billions. If the parsonage exclusion were eliminated, the federal government could recover approximately $1.5 billion annually in lost income tax revenue from clergy. This potential revenue stream could significantly alleviate budget shortfalls in local communities or fund secular public services, demonstrating the massive opportunity cost of the current system. Legal challenges to church tax exemption often focus on the argument that the exemption constitutes an unconstitutional subsidy of religion, violating the Establishment Clause. However, courts have consistently upheld the exemption, viewing it as a permissible accommodation rather than an endorsement. The primary legal hurdle for opponents remains the Walls precedent, which established that the exemption avoids excessive entanglement. Future legal strategies focus on challenging the lack of transparency and the failure to enforce political activity restrictions, arguing that these failures transform accommodation into unconstitutional governmental support. The continuation of broad, non-transparent tax exceptions for religious organizations fundamentally undermines the goal of a fully secular government. When religious entities operate outside the standard financial accountability required of secular organizations, they gain an unfair economic advantage. True separation requires that religious institutions, like all other private entities, bear the full cost of their operations without relying on indirect public subsidy. Moving toward a system where all organizations contribute proportionally to the public good is essential for fiscal fairness and maintaining governmental neutrality toward belief and non-belief.